Thank you, everybody. Thank you for joining us the end of the year tax planning in the COVID era, hosted by Agudas Yisrael. We are welcomed here today with some very, very prominent panelists, and I'd like to introduce each one of them and then turn it over to our moderator. Benjamin Berger. Benjamin is a public certified accountant for over 25 years as a partner of Bernath and Rosenberg.
Certified public accountant. Certified public accountant.
Sorry. Thank you, Zachariah. His specialties include high net worth individuals, real estate, and non-for-profit audit representation. He's also an active member of the Finance Committee of Agudas Israel of America. Shalom Rosenbaum. Shalom is a certified public accountant at Roth & Co. He's accredited in business valuation by the AICPA, and his specialties include forensic accounting, business valuation, and due diligence procedures. Shalom advises clients on estate planning, business succession, and asset protection planning. Abe Schissenfeld. Abe is a partner in charge of real estate group at Mark Bernath LLP. As of January 1st, he will be the co-managing partner, where his responsibility for advising commercial and residential and real estate owners, real estate management firms, and REITs on all facets of accounting and taxation. Abe has explored the tax benefit and implications of the Opportunity Zone program since its inception in the Tax Cut and Jobs Act of 2017. Zachariah Wetzler, hopefully I get it right now. Zachariah is a co-managing partner.
If you don't get it right, we've done this more than once. If you don't get it right, we have a problem.
Zachariah is a co-managing partner at Roth & Co., where he manages all facets of the firm's growth and development, forming strong relationships with government entities, banking and financial institutions, and has enabled Zachariah to assist growing and maturing businesses in a wide range of industries, including real estate, e-commerce, healthcare, manufacturing, and wholesale distribution, and non-for-profit. The common denominator between all of our panelists today are there for the individual and for the tzibur. It's a tremendous chus for me to welcome them all here today. I would like to just do a few housekeeping messages, and then I'll turn it over to our moderator today, Benjamin Berger. Today's CPA is being sponsored, accredited by ACE Seminars, and I will put a link in the chat button below for you to click on to get your credits. We will also be sending out a recording after the seminar to everybody that signed up, and there will be a fact sheet sent by our Chashuva panelist also. It is now my pleasure to introduce Benjamin to take it away for today.
Thank you very much, Naftali. On behalf of the panelists and on behalf of the hundreds of attendees, thank you, Agudas Yisrael, for hosting this webinar. We have a lot to cover. And as you will see shortly, there's a lot of uncertainty. President-elect Joe Biden has outlined potential tax changes, many of them. And I will outline them. I'll just give a list of them. We'll discuss them. But it's very clear that many of them do not stand much of a chance of being passed if the Republicans keep control of the Senate, or unlikely to be passed, at least in the initial days and months of the new administration, as he has also promised to spend a lot of time on the pandemic. So taxes will not be his first priority. But the implications of the tax implications for individuals that Joe Biden has discussed are raising the top rate from 37% to 39.6% for anybody earning over $400,000, limiting itemized deductions for anybody earning over $400,000, phasing out the QBI, or what we know as 199A, which everybody refers to as the 20% discount for anybody over $400,000, and that was a tremendous help to many businesses. And importantly, long-term capital gains, which are currently taxed at 23.8%, he wants to raise that to 39.6%, to the highest rate for anybody earning over $1 million. On the other hand, he is talking about additional credits, reinstating the first-time home buyers credit of $15,000, increasing the dependent and child care credits, increasing the earned income credit. With regard to estate tax and gift taxes, that is not very good at what he would like to do. He'd like to raise the rate from 40% to 45%, but more importantly, he's discussing lowering the exemption, which we'll talk about later on, which is currently at $11.5 million per individual, to possibly as low as $3.5 million per individual. And more importantly, eliminating a step-up basis. We'll discuss that later on. And then for businesses, he's talking about increasing the corporate income tax rate from 21% to 28%, and which could affect many people as well, taking off the cap on Social Security tax. Currently on payroll taxes, you're maxed out at $137,700. He wants to take off that cap for anybody earning $400,000 or more. So as I said, these are a number of tax items that he'd like to address. We don't know how much he's actually going to get to. With all this uncertainty, there certainly are a number of planning opportunities that everybody can still do prior to year end. We'll address those specifics of that later on in the program. But for now, I'm turning it over to Zachariah Waxler to give us an update on PPP and the forgiveness process.
I just want to jump in there, Zachariah, sorry about that. But just once, I know you started off with this, Benjamin. And first of all, I'm really excited to be here. Thank you, Naftali, for arranging this, and Zachariah, Shulam, and Benjamin. You know, I tell a lot of people I started my career at Roth & Company. I still have some friends there, so it's really great to be doing this together with them. And I still remember I guess when I started off with Agudas Yisrael of America, I was probably 5 or 6 years old listening to stories. I guess today I'll be saying the stories. So it's really amazing how the world revolves in a circle. But regarding the point of the Biden tax plan, and obviously that's something that's on top of everybody's mind. And do I do things this year, next year? And we'll discuss, as you said, a lot of that. And you said that there's not a great chance a lot of it will be passed. I like to put everything in perspective and remind everyone that when Trump took office and he had, you know, all three houses behind him, it still took him until December, I believe, was 17th to get it passed, and wasn't effective until the following year. So, you know, the chances of any significant legislation happening, and especially it being retroactive, is, if I could take on my silver ball, slim to none. So it's good discussion, but at the same point, it's, you know, the reality is.
You know that always, you know, when they have the candidates and whatever they say and whatever their plan is when they're running is always different than reality. Let's be realistic. They're catering to a party and to people who are going to vote for them, and then when it comes down to it, it's not even necessarily close, right? Probably going to make some of these changes, but I can't imagine they're going to make all of them. But we definitely have to at least think about it, right? You know, and the just in case scenarios, and if we can avoid anything, I think it's something we should try to do.
Right, and certain things, you know, for instance, the estate planning are things that people should be doing irrespective of whether or not it will be changing. It's just, this is a good way of incentivizing people to hurry up.
Yeah, no, you know, yeah, it's true. I mean, it's another reason to bring up that conversation. Like, what about estate planning? Did you do it? Right? This is probably on all of our almost top priorities when we really want to help our clients, right? Let's be realistic. It's an important thing to do. So every time it comes up in anything newsworthy, we say, hey, how about let's take advantage of it, right? Change in administration is always good for our business anyway. So
keep the accounts in work act.
Exactly.
I do want to add, if you're talking about estate planning, we have another opportunity now, because in addition to the potential changes in the tax law, because of COVID, valuations are low as well. So there's another reason why estate planning is especially important now.
Yep.
Okay, so that being said,
in New York City have gone down?
Are you kidding me?
No,
you're in the city now?
I'm in the city.
Is there anybody outside? Can you look out the windows? Anybody outside?
There's quite a bit of foot traffic and cars. Yeah.
Oh wow. Good. Okay.
I did drive into the city this morning, and the traffic is noticeably lighter when you drive in. You know.
All right. Okay, so let me jump right into the to some of the updates on the PPP forgiveness. I'll start off. Shulam is here to help me out on that. Part of his team is the team that deals with it on our end in terms of helping our clients or anybody else with the forgiveness. So just as an update on the forgiveness. Most bank portals are open. There's some that are not open yet, but most bank portals are open. We actually successfully processed some forgiveness applications, approved and done. We've gone through that process. It's possible to be done. It's doable. Banks are accepting it, and we've actually processed, and some people actually have that forgiven already. But there's no immediate deadline in terms of when this has to be done. Right, when the forgiveness has to be applied for. December 31st is an important date, but not necessarily a deadline that has to be done. So it's an important date because the payments if the PPP loan will have to be repaid for whatever reason, payments only start 10 months after the covered period. So the 24 weeks, the covered period that would be covered under the PPP, payments only would have to start 10 months after that. But the application for forgiveness could be filed until the maturity date of the loan, which is 2 or 5 years, depends in when the loan was originated. Right. So again, there's no rush to go for forgiveness. You can technically do it for another 18 months or so. And if the FTE or salaries decreased, you still have until December 31st to bring that back up to pre-COVID levels. So that's why December 31st is an important date, but it's not an important date for forgiveness. In terms of the deductibility of expenses, there's been back and forth, and I'd like Shulam to give us a little bit of an update about the deductibility or the non-deductibility expenses and where that's holding.
So the CARES Act specifically had that provision that the loan will be forgiven tax-free, and unfortunately, the IRS came back, and the IRS said that the PPP loan proceeds, although if they are forgiven won't be taxable, if it is used for expenses such as payroll and other qualifying expenses, these expenses won't be deductible on your tax bill even in 2020, regardless of when you file for forgiveness. Some people believe that if you wait to file for 2021, they'll be able to defer and recognize the income. Effectively, you're recognizing income on the PPP loan because you're not taking the expense as a deduction in 2021. That's not true. The IRS specifically said that the income must be included or the expense cannot be deducted in 2020. However, there are planning opportunities with this, and we have yet to see, obviously, Congress, specifically those who wrote the law, such as Marco Rubio, as well as many memberships, including the AICPA, all opposed the IRS's explanation of the non-deductibility of PPP spending. So we have to wait to see what's actually going to happen in the long run.
The AICPA. Yeah, the AICPA has been very, very, vocal about that. They've been, they still maintain that the law, the intent of the law was to be able to deduct these expenses, and I know they're lobbying very strongly. I guess it depends who's going to be the president. I'm assuming. I don't know. Again, we're going with the assumption that it's Biden, and I don't know. Yeah, it's probably done anyway. But I don't know what Biden, what his position is on the deductibility or not. So I guess it's kind of going to depend on the administration somewhat, I'm assuming.
Hey, we can go back to Abe Silverball over here. I know you said that, Zachariah, that you started doing some PPP forgiveness. If legislation does change it and make it deductible, how will it affect those that you already did?
I think, well, it has nothing to do with forgiveness, right? It has nothing to do with the forgiveness aspect. Forgiveness is going to be the forgiveness. The question is when you file the return and you don't deduct the expenses, what is the change in that? I guess we're going to, us accountants will have to determine to see where it's heading and when we're going to actually do the filings for these returns, right? Technically, they may say if you didn't take it, if it comes to the point, I'm thinking, if it comes to the point that they'll allow the deduction, maybe they'll say if you didn't file yet or amend it or do whatever it is. But I think it has more to do with the filing of the return and not the forgiveness.
No, I agree with that, and it seems that most accountants are taking the position that plan for it and do your year-end planning, that it's not going to be forgiven. I mean, that the expenses will not be deductible. Plan for the higher income, and we'll have to put returns on extension until we have some clarity on this.
Right, it will be very
Correct.
similar to a few years ago when on the TCJA 163J, we told everyone, put your returns on extension, and we'll know more before September 15th. We'll file the returns then, and then behold, September 15th came and went, and we didn't know anything further. So we may be in a similar situation also.
I would suspect that, yeah. I think we're going to do lots of filings before anything comes out, even if that, and then there's going to be some kind of process of when what should be changed, and that'll take another bunch of months to figure out that process. So it'll just keep us busy. Shula, I'm curious. Is there specific expenses that we need to offset against this forgiveness? Like is these expenses non-deductible or deductible? How does that work?
So from a PPP standpoint, the SBA didn't specify how to allocate the expenses. Conceptually, so long that you spend the money on the proper and qualifying expenses, then you can file for forgiveness. The IRS, however, went that far to say that even if you allocate some of these expenses to something that you would capitalize, meaning you would include it as part of your inventory or maybe as part of a construction of a building or an asset, that would not be able to be capitalized, meaning even if you wouldn't expense it, you cannot capitalize it. But I do want to say that there are planning opportunities there, because even if you don't capitalize it, you might not have to pay the tax this year because it's not an expense for this year. So if you can allocate, if you have a lot of inventory costs and you use 263A, allocation, where you allocate some of your payroll to inventory or to the construction of assets, you might want to allocate some of your PPP funds to that. So at least you defer it for another year or whenever you sell that inventory or the fixed asset.
It's interesting. It's an interesting point, actually. I mean, for those who, I know we have a lot of accounts, but for those who don't know what 263A costs are, you want to explain that for a second?
Okay, so 263A is basically a uniform capitalization. It involves much more than, it's obviously beyond the scope of this webinar, but it basically says that when you have inventory that you actually manufacture on your own, you have to include in the cost of inventory not just the cost of goods that you paid or the goods of direct materials or raw materials, you also have to include any labor that goes into the production of the merchandise. So for example, if you buy something as a wholesaler or retailer, you buy goods, there's no 263A, but if you manufacture it and you have a staff working in the factory, their payroll would be allocated to inventory.
So in reality, what we're doing, it's not necessary to really get into details, but in reality, what potentially anyone could be doing is really postponing, even if we're deducting, potentially, even if the expenses are not deductible, but we're kind of postponing really paying taxes on this to next year or whenever the inventory is sold, right, to next year, that kind of concept. Right. So for planning purposes, that's really good planning opportunity. Just to get back to this December 31st, is there any harm in waiting or for applying for forgiveness or leaving it now? I think there's some things that we need to take into consideration. Having an outstanding loan could affect debt covenants, mortgage renewals. Sometimes people have loans with agreements with the bank. Bank restricts additional debt if they didn't get a waiver for PPP. Lots of people got waivers from the banks allowing them to take these loans, but if they didn't get waivers, this could be a little bit of a blown covenant. It's still debt. It's still considered a loan. Actually, for financial statement purposes, it isn't. If it's reasonably expected to be forgiven, I believe we can take the position that it's income. But That's a separate comment as I'm talking about this. And if you received a loan less than $150,000, there might be just an automatic forgiveness where you don't have to go through that process, and it might just be worth waiting. And also another reason to wait is if the FTE went down. So there's a bunch of reasons why you could, there's no real harm in waiting if you fall into one of these criteria. But if anybody that took a loan with a PPP loan less than $50,000, it's like a seamless form 3508S, a one-page. Basically, you're confirming that you spent the money on qualified expenses. You don't have to submit any documentation. You have to retain the documents for 6 years, but you don't have to submit it. Obviously, they could come back and audit you. I wonder if they would for that dollar amount. But anybody that has that could just do that on their own. Pretty much fill out this one-page form and get it forgiven. Let's talk about the forgiveness process, right? So applying for application, Shulam. So I'm curious the process we had. What was our process when we helped our clients actually do that forgiveness?
So I think the process is actually at this point simpler than what we originally thought. It helped a lot that they extended the period to 24 weeks. So if you can use only payroll to file for forgiveness, it has been pretty seamless. The documentation requirements are not as excessive, and if you can just file payroll reports with your payroll company, obviously I would suggest that you have someone, an accounting firm or someone else, either process the application or review your application, but it's seamless if you can rely only on payroll. Obviously depends if you have less than 50, which as you mentioned is simplified. If you have more than 50 but your FTE count didn't go down or the government shut you down, it's still pretty simple. You can use the easy form. But if you have FTE reduction, you should consider consulting it with an advisor. There are remedies to it. And more importantly, if you have more than $2 million, if you received more than $2 million collectively as an organization, even with affiliates, then there are additional forms which the SBA recently released that I've seen some clients receive it. Most people did not receive it yet, but you have 10 days to fill it out and return it once you receive it, so it is time sensitive. And they ask quite a couple of questions that many people, including the AICPA, didn't like to assess your business or your liquidity as to whether you really needed the PPP. And there you might have to include additional documentation. But other than that, it's pretty seamless, pretty straightforward.
Okay. I think we're done.
Okay.
Back to you, Benjamin. To the forgiveness aspect, and again, hopefully something will either be in the current stimulus bill that's floating around, which who knows if that will pass or not, and there's some deductibility talk in there, or possibly in the next administration. But under an assumption that we have to, as we said before, we have to go by what we know now, and under an assumption that it ends up being non-deductible, there's obviously a lot of different schools of thought as to exactly how that gets presented, and there may actually be some issues and or planning opportunities to think about both with 199A as well as state apportionments with regards to either payroll or if you reduce your other expenses, and obviously depending on the numbers, there could be some play there that will affect other items in addition to your federal income tax.
Right now, I agree with you. For you don't want to reduce payroll to affect the 199A. There is a planning opportunity as well for those that are in New York City, Zacharia, in Manhattan at least, that are paying commercial rent tax. If you can do that allocation against your rent being paid, that can bring you down also below the threshold and get an extra credit there as well.
That's
right.
So there are planning opportunities.
Yeah, I think there's some room. I think there's some room for creativity. Yeah, at least to the best we can. It all depends in the dollar amount, but at least to the best we can.
Exactly. We don't want to lose focus on the forgiveness, which is the ultimate, prize in this. And if we make things too complicated and the banks start pushing things back and eventually losing on forgiveness, we defeat the purpose. I also want to point out that some banks, even though the documentation requirements for some forms are pretty simple, there may be certain banks, for their own purposes, they want to, make sure that they're protected from any future liability. They may collect more documentation than others, so you'll experience that some banks are different than others.
Before we pivot over to Abe to talk about the opportunity zones, just again, back to housekeeping. For those that need CPE, the link will be put out in the chat, but there are 2 codes that we have to share, which you will have to provide with the evaluation. The first code is G15. G15 is the first code. Okay, Abe, opportunity zones. It's something you've been living and breathing for the last, I guess, 2 years. You've read through thousands of pages of proposed regulations, final regulations. I've read a lot of your material and your information that you've shared with people on this. Can you give us an overview and then get into some practical applications of how we can use it?
Sure, and I'm going to try to keep it at a very high level, and I'm going to try to focus on the benefits that an individual can have as opposed to the actual opportunity zone world, because otherwise, we can literally be here for hours. The opportunity zone, is, some of you may or may not know, was part of the Tax Cuts and Jobs Act that was passed in December of 2017. It was almost stuck in there. No one was talking about it. Everybody was talking about everything else, the SALT deduction and, tax rates and 199A and 163J and everything else that was mortgage interest, everything else that was in the tax law. And I actually vividly remember, it was, I'm trying to remember the exact date, but I believe it was March 6th of 2018. I did a presentation. It was actually together with Abe Leitner, who a lot of you may not know. He's a tax attorney, and other partners of his. And at the end of the presentation, we stuck in around 30 seconds on opportunity zones. And, and then it was shortly after that I guess a lot of the press got a hold of it, and a lot of sponsors. So it became the hottest thing since sliced bread. And then the newspaper started attacking it, and I started telling people all along, it's not as big as the hype, but it's not as bad as the hit job that all the press are doing on it. And if it works, it works. And as a matter of fact, if it works, it's a grand slam. So just as a very brief overview, for anybody, the entry ticket. In order to have an entry ticket into the opportunity zone world, you need to have capital gains. And it's really simple. You have to show capital gains on your Schedule D, and it could be a partnership, corporation, an individual, and we'll get into some of the nuances there. But if you have capital gains, you now have your entry ticket into the OZ world, opportunity zone world. And for a lot of real estate people, obviously 1031s have always been around, and we can debate from today till tomorrow that whether or not 1031s versus OZ investments, and there are pros and cons to each. As a matter of fact, one of the Biden proposals is to remove 1031 exchanges for those making of that. So, who knows what will be with that. So essentially, if you're an individual and you have a capital gain, there are a lot of different windows that you can make your investment in. If you sell something personally, you have 180 days. You sell stock. You sell a building. You sell a partnership interest. You sell a piece of art. You sell a company that you own stock in. So you have 180 days from the date of the sale to reinvest. If you have a partnership interest, you have a few opportunities where you can elect to do it 180 days from the date of the actual sale, assuming you know about it, or 180 days from year end. That was in the initial law. Then, as Ben mentioned, there's been multiple revisions to the law, and not as many as PPP, but there have been multiple changes, and I forget the exact date. It was December or something of last year, 20-something, when they came out with the final regulations. And if you're an investor in a partnership, they gave you essentially until September 15th of the following year to make your opportunity zone election. So essentially, if you have a pass-through income that's capital gain or 1231, I'm not going to get into all the nuances of 1231, but assuming you have capital gain or 1231 gain, sale of real property gain coming through to you on a K1, you can make your investment anytime in the following year up until September 15th and still include it on your prior year tax return. Then comes along COVID, and in late May, I forget the exact date, maybe it was early June, the IRS came out and says, because of everything that's going on, you can actually have until December 31st of 2020 to make an investment on behalf of 2019. So for those of you that had large gains in 2019, there's actually still an opportunity to make an opportunity zone investment and amend your 2019 return and get some money back from the government, as well as if you had 2020 gains. There's a one-time, I'll call it a freebie to extend it that long. So what are the benefits of opportunity zone? For starters, you don't pay any tax now. So let's assume you had $100,000 of capital gain. You make election on your return. A partnership can make the election, or an individual. You make the election on your return, and you don't pay tax in 2019, 2020. And there are certain forms that you have to file, both at the partnership level, the individual level, and I don't want to get into all the compliance issues with regards to that. And then in 2026, you pay tax. It's actually going to be April of 2027, and you shave 10% off of the gain. So if you had a $100,000 gain, you're now going to only pay tax on $90,000. If you made your investment a few years ago, you got an extra 5%, but we're out of that window. So you're going to pay tax on $90,000. The thing I keep on reminding people is you're going to be paying tax on whatever the capital gains rates are in effect at that time. So if the gain that you had was long term and you paid tax at 20 or 23.8%, and as Ben said before, if Biden's proposal ends up increasing that to 39.6, it's something to consider. If you were short term gains, obviously much less of an effect on your future tax flow. But the truth is, and first of all, I tell everyone all the time, it has to be a good investment, irrespective of the OZ benefits. That's number one. This is just I call it a sweetener to the deal. But the real home run of opportunity zone investments are, because remember, you still pay tax. One of the biggest fallacies out there are that you never pay tax on this investment. You still pay tax on the operating income, and actually have less basis for depreciation because it was an opportunity zone investment. So you still pay tax on all the income, and if it's operating business, you obviously will definitely pay tax. The real kicker here is if you hold the investment for at least 10 years, and you sell it, you can't just walk away from the investment. If you sell this investment after 10 years, I think now you have until 2050 or something like that. But then you pay zero tax. So if you had a $100,000 gain, invest it in a property or in a business, and you end up selling it for $1 million, and 12 years from now, you pay zero tax on that gain, which is really what the huge benefit here is. And for those that are in the real estate industry, I call it the grand slam of all this is if you buy real estate in Opportunity Zone and you depreciate it, and this came out, I believe it was a second set of regs, which was, if I recall correctly, it was Erev Pesach. And that second set of regs basically said that depreciation recapture is also not taxed. So you make your investment and pick the number, 100,000, add zeros, subtract zeros from that, and you depreciate it, and you get basis for your debt and other items, and none of it is recaptured upon the sale, so long as you hold it for at least 10 years. So, there's some great opportunities there. Again, you can go back to 1920. So is it for everybody? Obviously some of I'll call it the bigger players are doing more of it. A lot of people read about it. But that being said, any individual that has capital gains on their returns can make the investments. It's, everyone views Opportunity Zone funds as some fancy investment vehicle. The fact is, all it is a partnership. It's a 1065 where you check a box, you have a few forms you have to file. It's not that big of a deal. I would recommend, if you're not in the business, to invest with someone that knows what they're doing. Not an Opportunity Zone knows what they're doing. Someone that knows what they're doing in the business that you're investing in. Isn't that the case with every business? It's the case with every investment. And you know what? I tell people all the time, whether it's in the Opportunity Zone world or whether it's tax rate changes or whatever it is, don't let taxes drive your investment decision. And as much as it hurts to say that, 'cause I'm an accountant, it's true. Don't let taxes drive your investment decisions. They may, listen, as with every investment, you have to look at the whole environment, and whether it's tax incentives given by local governments or tax incentives that are in the federal tax law. Everything obviously is part of the equation. But don't let some headline decide how you're going to invest or where you're going to invest.
Yeah, like buying a plane or something.
There are certain opportunity zones that you can make minimal investments. There's actually at least one, and could be there's more. So I'm not going to name that one, but there's at least one publicly traded opportunity zone REIT. I think the minimum investment is $10,000. So it's easy to make the investments, who knows what's going to be. A year ago, a lot of people said, oh, opportunity zone's not such a great. I have to hold it for 10 years. A lot of people have 5 to 7 year hold horizons. Well, now that you fast track a year, and as Shulman mentioned before, with valuations lower and purchase prices being lower, perhaps some good investments out there in the opportunity zone world. And, all of a sudden now a 10-year hold is not so long for things to turn around. The big joke going around in early June was that the whole Manhattan will be designated an opportunity zone in the next census. Hopefully that won't happen. But there's so much more to opportunity zones, and Ben warned me before that I'm gonna have a hard time, keeping it simple, and a little sweetener, as I call it, taste. There's what I have to offer.
Hey, you did a good job. You did a good job in that, and we'll try to get to a couple of practical applications if we have time in the questions later on. I want to circle back again beforehand. Let's just take care of housekeeping. The second code needed for CPE is G25. So you have G15 and G25 for those that need CPE. I want to go back just to touch on the estate planning and then talk about some of the changes in Medicaid and specifically in applications for community Medicaid. So, for estate planning, the current lifetime exemption that a person can die with and have no estate tax is $11.5 million. Anything above that, the tax is currently at 40%. The vast majority of people pass away do not have the amounts in excess of that, and I think it's less than 1% across the country that actually pays an estate tax. New York's exemption is only at 5.9 million. Even that is a high bar to cross for many people. However, if Biden gets his way and they bring it back down to the $3.5 million, that can be an issue for many people that own their homes, that houses that went up a lot in value, as well as having shares in a business, etc. The step-up in basis is something that I touched upon also, and just for an example of what step-up in basis is, somebody bought a house, many years ago, 30, 40 years ago for $100,000, and today the house is worth $1 million. A parent passes away, they inherit it at $1 million. The beneficiary's basis in this house will be $1 million. They can turn it around and sell it a week later and pay no capital gains tax on that at all. So there is a benefit sometimes if your estate is below the threshold to keep your assets or your appreciated assets in your estate so that you do get the step up in basis. One of Biden's proposals has been to eliminate the step up in basis unless you actually pay estate tax on it. Again, this elimination of step up in basis has been discussed in the past. It's really a very, very slim chance of it being passed. But there certainly are, for anybody that does have a significant estate, there certainly are opportunities that might not be available at, in late 2021, and certainly if it was retroactive. So, I encourage you to speak to your estate planning attorney if you can actually get an appointment. Anybody I've spoken to is just overloaded with work, with people trying to rush to get in. And like Shulman's point was as well, that there are lower values right now. So those that are doing appraisals right now might be shifting and not using up as much of their exemption as they would have to do. Turning to Medicaid. The Medicaid, most people know Medicaid for its coverage, for its nursing home coverage. If somebody has to go into a nursing home and doesn't have private insurance, the private pay is exorbitant, and most people get covered either by Medicaid or Medicare. So it's income-based eligibility for Medicaid is income-based and asset-based. I'll talk about the asset side right now. Currently, I believe an applicant alone is only allowed to have $15,000 in assets, and the spouse is allowed to have $128,000 in assets. So people say, oh, no problem. If I see my spouse will have to go into a nursing home, I'll transfer my assets at that point. You can't. There is a 5-year or 60-month look-back period that Medicaid will go back and look at all transfers and gifts given by the applicant or the spouse during the previous 5 years and add those back, and it ends up being a penalty period where they will not cover. So that was Medicaid rules. That's been Medicaid rules until now. Community Medicaid was much simpler. Community Medicaid, which covers, you see many people have caregivers these days, they want to stay at home, and they apply for Community Medicaid. Community Medicaid's application was much easier because there was no look back period. So somebody can have $500,000 in the bank, see that they're going to need Community Medicaid, they write a check to the child, they do the $500,000 gift. The next month they make an application, they show they have less than the eligible amount in the bank, and they're approved for Community Medicaid. Effective for all applications beginning April 1st, 2021, there will be a 30-month look-back period for Community Medicaid as well. Again, I'm giving it in general terms when I say 30 months because the look-back period will be phased in over a number of months until April of 2023. But by having this look-back period now and not doing any transfers and applying for Community Medicaid, if you see the need for it now, you will have to go back and look at provide all the financial information, and Medicaid will go through all your financial transactions for the last 30 months to see if there's a penalty period as well. Now, obviously, this causes extra hardship because if there were transfers and they do not cover and you have the penalty period, you're going to have to pay out of pocket. In addition, there's the backlog of applications at the Department of Social Services that's going to approve this, and this can really take some time. So again, if this is applicable to anybody, I encourage you to speak to a professional that deals with these applications. Yes, you can do it on your own, but again, as most things, there are very specific eligibility criteria, and one mistake on it can end up costing you a lot more money than the application fee that the one that does it is going to charge you. I do want to address a topic now that applies to every participant on this webinar. I'm going to refer to it as a letter of instruction. It might not be directly tax driven, but it's something that I'm passionate about because I've seen this so many times over the last 15 to 20 years. What I'm referring to is basic financial information that everybody has and that your spouse might not be aware of. And unfortunately, death or disability can strike at any time. And when that happens, not having access to all this information just adds on another level of hardship and stress on a family during this most trying time. Lest you say this doesn't happen, I mean, just look at the last 10 months of COVID. Ms. Askim has told me they added 113 almonas from our community to their list. It's safe to assume that the majority of them did not have the financial savvy or certainly the financial knowledge of items that were needed during those trying times. So I'm going to run through a number of items, and when we send out a fact sheet after this webinar, we'll include them as well. Number one, everybody should have a halachic proxy. Halachic proxy is a healthcare proxy which allows you to appoint somebody else to make healthcare decisions if you are not able to do so. This proxy, especially in these days when the hospitals have extremely limited visitation, and in the most dire circumstances, nobody from the family might be there, and the doctors will do as they see fit based on their protocol, notwithstanding that you're an Orthodox Jew and you have your own requirements. This healthcare proxy is available on Chaim Aruchim's website. Aguda has developed it. It's free of charge. It's an easy download. I encourage you to download it, sign it, and then give it in to make it part of your medical records. And if unfortunately the need is there and the person's not able to make the decision, and a family is not able to make a decision, you can put in there also to ask a specific rabbi or any Orthodox rabbi. Item number 2 is a power of attorney. A power of attorney also is available on Chaim Aruchim's website. You can limit it for certain things. Again, if somebody's not a signatory on a bank account, and it can limit access to any financial transactions. Everybody should prepare a list of bank and brokerage accounts, passwords to your online banking, to your email, to your cell phones. These are all things that might sound very simple, but trust me, I've been there, I've seen it. It adds on such a level of stress in the most trying time. You should also give the contact information for the Chevra Kadisha if you are a member of one. If you are not a member of one, I encourage you to join one. There are various different Kehillas, very different Kreisen, they have their own Chevra. It's something that allows you, therefore, to have your own decisions on what you want to happen. And it also removes the tremendous stress from the family during those most trying times. I've been called to houses already where it's unfortunately right after the patira, and they have to make decisions, and they start making phone calls. What did he really want? What did he want? We don't have kaka. We didn't know about it. And there are financial ramifications as well. If anybody had to call up a funeral home and ask to do a levaya, the cost is $8,000 to $10,000, which has to be paid up front. If you're a member of the Chevra, in most cases, it's a one phone call. They take care of this, and it just removes a lot of uncertainty and a lot of stress in this time. I understand discussing and dealing with these issues is not comfortable, but is extremely important. Let's turn our focus back to taxes now. Abe, can you please discuss?
Wow, that's a big load, but it's true. I totally, I don't know if there would be any time that this is a good topic to a good conversation to be had. I think at this point people understand it a lot more. So it's if there's ever a good time to talk about it, now is the time. But this is really is a very depressing conversation.
I said it's uncomfortable to talk about, and unfortunately, it's a lot more uncomfortable after the fact.
Right, but remember also, they say there are two things that are certain in life: death and taxes. So.
There's no question. I'm not questioning our mortality, right? But this is just it is what it is, and it's definitely something that needed to be said. I'm listening to this. I'm like, oh wow, this is like tough to listen to. So I'm sure a lot of people feel that way, but I think it was extremely important.
Yes.
I would just add.
I'll say this.
I worked together with Binyamin on one of those cases that he mentioned, and the amount of effort and stress of the people involved were so much greater because the family did not have the documents. So it is a very hard thing, like Zachariah mentioned, but it really simple forms just make your life so much easier. And and Bez Hashem, like they always say, preparing for that, it adds life. It's like, we should all have live to 120, so it should be a schus for us all.
100%. I think as many times as we talk about it, we can't stress how important it is. I mean, let's be realistic about it. But I think it was it was spot on and the right format for it. So.
Right.
Okay.
To add on a little bit on that, Ben. And to add a little bit more to the depressing conversation, you mentioned the new almonas that Masaskim added to the list. I was actually called to a couple of those cases where they didn't have those lists, and cars were repossessed because no one knew where payments have to be made and whether automatic payments were set up. Investments that were lost. People had investments. The banks came in. So these are issues. If we don't have this, you can lose your home, you can lose your car, you can lose actual assets, and that's even more depressing than anything. After you've lost a loved one, to lose whatever you attach you to that loved one as well.
Fully agree. Okay, Abe.
Okay.
SALT. Explain what it is and what our new workarounds are.
So I'll talk about salt in a second, but salt, at least, I live up in Muncie, so we put salt on the snow. I don't know if people can see from my camera behind. It's actually snowing in Midtown Manhattan right now.
Oh, wow.
Yeah, it's snowing in Fire Park as well.
Salt. But no, I don't know if this is the first snow of the year or not. I can't remember. But,
yeah, I think it is. I think it's the first time. Yeah, I didn't even know we were expecting snow.
Well, it's our fault because we decided we're going to talk about salt. So very quickly, we don't have. By the way, I know we all have a lot of power, but I'm not sure we control the weather that way. But it just worked out. So just very quickly, I know we don't have that much time left, and everyone's talking about Biden's potential changes, etc. And the one thing that sort of gets lost from the mix is whether or not they're going to remove the SALT deduction, no SALT cap limit, sorry. Back in 2018, effective at TCA, everyone knows that our state and local tax deduction, which includes income taxes, real estate taxes, was limited to $10,000. So putting aside whether or not that gets reinstated next year, but the fact is for business owners, not necessarily for individuals, well, some individuals, I'll get to that in a second, there are actually some opportunities that are available in 2020 as we speak to benefit from it. There's a few states, and Connecticut enacted this right away in 18, and New Jersey just enacted something in 2020 where they've come out with a SALT workaround and basically pass-through entities can pay tax and deduct it at the federal level. And then there's all kinds of weird computations that get done on individuals. But basically, in a nutshell, for if you have businesses that are operating in Connecticut, New Jersey, I believe Maryland has something, a few other states also. There are opportunities that are available now. A lot of people were hesitant to use them or believe in them because everyone thought that it was some, creative way that, as we know, every time everyone came up with creative tax planning advice the last few years, Treasury figured out a way to slam it shut. But believe it or not, a few weeks ago, they came out with a notice saying that those, commonly known as assault workarounds, are completely legitimate. So, irrespective of whether or not the SALT cap limit gets removed next year, there's a chance, I don't use the word good chance, but there's a chance that other states such as New York, which I imagine is predominantly where most of the viewers here are from, that they may pass something like that. So, it would be a home run. New York actually has something. It's a very complicated and unused payroll tax workaround. Let's put it this way, it is so unused that I just heard recently that there are 262 companies in the entire state of New York that utilize that workaround. It's through payroll taxes. You have to make the election on December 1st of the year before, so it's too late for next year anyways. But stay tuned. Hopefully New York State will pass something for next year. But again, for those in New Jersey or Connecticut, you have opportunities this year, and especially if you're a cash basis taxpayer, make sure you get up to speed on that. And some, again, weird rules with double paying the tax in New Jersey. On the flip side, if you're a New York business, you have to start weighing the, accelerating income to this year, next year. I'm always a big fan of deferring because who knows what's going to be. And as I said before, I'm not so sure anything will get enacted in 2021. But if you weigh that together with the additional possibility of there being some sort of a SALT workaround passed in New York State next year, it's just something to consider.
Okay, we're coming up with only a couple of minutes of time. Zachariah, do you want to touch upon charitable contributions and what we can do in 2020?
Yeah, sure. So we do have an exception this year that we can take 100% deduction on AGI on charitable contributions. We'll talk about to who in a minute, but it's I don't know how many people in general, I'm talking about the United States, take advantage of the 50% or the 60% deduction. I think with us, with our community and our ILM, there is that possibility potentially. Some people want to have various charitable contributions, legacy reasons, donating a building or whatever it is that end up going above the 50 or 60% deduction as is. So they did change the limitation. Interesting. I did have a conversation with a client yesterday, and he had carryover, charity from prior year. So what happens is with the carryover is that it gets first applied before your 100% kicks in. So what happened was he had 50% of his AGI actually carrying over. For him to hit 100%, he has to donate, if he wanted to, another 100%. It's not like an additional 50 would take him to that 100% AGI. So it's an interesting point that I didn't even do research. I'm assuming you guys all knew about that, but it's an interesting point that we have to take into consideration. Sometimes we think, hey, I'll give 100%, but then you don't realize you have carryover. That's first. That means sometimes you think, hey, I have carryover 30% or 40%, and I'll do more, but it's not necessarily going to help. Private foundations obviously are not part of this, and donor advised funds for the most part are not out of it. So if you were going to give it to a donor advised fund, it's not going to be that 100% to AGI deduction. If Shulam can clarify, because he actually just clarified to me yesterday, if the donation is to an organization who happens to have a donor advised fund is one thing. I think potentially we could have that 100% deduction, but it can be, specifically a donor advised fund without saying actual names, because it's hard to determine, who's an organization that has a donor advised fund versus who's an actual donor advised fund. So I'm not sure the exact difference, but I do know there is some difference in terms, even if you're giving it to a donor advised fund, but if it's an organization that also has donor advised fund, might qualify for the 100% deduction.
Meaning if a public charity establishes a fund, and you can recommend to the public charity where to use, I guess, your donations or to what mission they would use it, that would qualify because it's still a donation to a public charity.
Okay, one thing just to add on this, and which is a great takeaway tip as well, we're coming up at the close, is donating appreciated securities. The market's at an all-time high right now. And you get the double whammy, and especially for people that are looking to maximize on the charity this year.
Yeah, but if I'm not mistaken, I don't remember this offhand, but if I'm not mistaken, the 100% rule doesn't apply to appreciated securities. I think it has to be cash in order to qualify for the 100%.
Cash. I thought so too. Shulam also, yeah?
Cash,
Yeah.
but you can add that 30% limit, let's say, to the AGI above your 100% cash deduction.
Right.
So there's still opportunities there.
Right. Yeah. For example, even the person that's not getting to the 100%, if somebody wants to give a $100,000 donation, and he had a great year in the market's at an all-time high, he sells his securities, he's going to have $100,000, let's just say, for argument's sake, the stock cost him $50,000, he sells it for $100,000, he has a $50,000 gain. He would have to pay, let's use round numbers, 30% on that. He'll pay $15,000 in tax, and he'll be left with $85,000. If he contributes that $85,000 to the charity, he's only going to get a deduction for approximately 30% of that, which brings him down to about the $25,000 savings. If he donates the $100,000 of appreciated security, he'll get a deduction, a charitable deduction for the full $100,000. So he'll get the $30,000 value. Plus, he'll save the $15,000 in tax as well. So again, anybody that's looking for the year-end opportunities now, certainly look at the donation of appreciated securities.
Long-term capital gain. Just to point out, that has to be long-term.
Property, obviously property as well. We've seen that, especially when it comes to, yeshivas, and there are people who have property and then they'll donate it towards the end of the year for the yeshiva building or whatever. There is some opportunity there as well. Also, not to the 100%, but also being able to kind of get the deduction without taking up the income.
Okay, we're coming up at 1 o'clock. There are quite a number of questions that came in. Many of them are redundant with the same questions regarding the RMDs and the requirements and the qualified charitable deductions. We'll address them in one fact sheet and be sent out by Naftali. Thank you, gentlemen, very much. Thank you, Naftali, very much.
Thank you, everybody, for joining. Have a great day.
Thank you all.
Thank you.
Okay.
Enjoy the rest of the day.
Thank you.